Hello, this is Abhilash. In this session, we are covering the investment management, the objectives of the investment management. So, meaning of the investment: the investment is putting money into something with the expectation that it will generate income or the value will appreciate in future or profits. So, that's how the investment is done. Definition of investment: the commitment of funds made in the expectation of some positive rate of return, that is called as an investment. The investment is the employment of funds with the aim of achieving additional income or growth in value. Expectation of return is an essential element of investment. Meaning of investment: it involves the commitment of resources which have been saved or put away from current consumption in the hope some benefits will occur in future. Investment involves long-term commitment of funds and waiting for a reward in the future. The financial meaning of the investment: the investment is the commitment of a person's funds to derive future income in the form of interest, dividends, premiums, pension, or appreciation in the value of their capital. Economic meaning: a net addition to the economic capital stock which consists of goods and services that are used in the production of other goods and services. Financial meaning of investment: financial investment involves of funds in various assets such as stock, bond, real estate, mortgage. Characteristics of investments in the previous session of the investment management. So we have discussed the characteristics of the investments. So you can just go through again. So what are the characteristics of the investment? Okay. So next we will discuss the objectives of the investment. The first is the maximization of return. The second one is the minimization of risk, and the third is the hedge against inflation. Right. So actually, there are the other on the other side. You can see the other objectives of investment as well: to keep money safe, to help money grow, to earn a steady income, to minimize the burden of tax, to save up for retirement, to meet your financial goals. Right. So there are also the objectives of investment. So basically, as per the theory parts, we have a three objective. One is maximization of return, minimization of risks, and third one is hedge against inflation. So let me throw some lights on these three objectives, right? So let me start with the maximization of return. So if your primary objective is the maximization of return, you will have to sacrifice a degree of safety in order to increase your return. So even the most conservative investors likely to have some level of income in their portfolios just to keep up with the rate of inflation. Example, investing in stock market earns a higher return with the higher risk. Right. The second objective is the minimization of risk. That is the you can say the safety of capital. While there is no such thing as an absolutely safe and secure investment, or one that is completely risk free. If your primary objective is safety, you will look for investment that have a minimal risk to level. But then the safest investments tends to have the lowest rates of return and may not keep up with the inflation. Safe investment include government issued securities, money market instruments, securities guaranteed by bank. Right? Hedge against inflation, the third objective. If you are growth oriented, you will normally are less concerned with the safety, do not totally depend on income from investment funds. This type of investment is in growth instruments are likely more likely to fluctuate in value and might have a great risk loss. Example, investment in shares of publicly traded companies are usually associated with the growth and are generally considered higher risk investment. Inflation hedge is an investment that is considered to protect the decreased purchasing power of accuracy that results from the loss of its value due to the rising prices, either macroeconomical or due to inflation. So inflation hedges can be used to offset the anticipated drop in the currency price. Limited downside risk is a major commonality between the institutional investors and the currency hedging is a common prices. Inflation hedging can help protect the value of an investment. Certain investment might seem to provide a decent return, but when inflation is factored in, they can be sold at a loss. For example, if you invest a stock that gives a 5% return, but inflation is 6%, so you are losing that 1%. So assets that are considered an inflation hedge could be self-fulfilling. Investors flocks to them, which keeps their values higher, even the intrinsic value may be much lower. So these are the objective of the investment theoretically. So in the next session, we will discuss the objectives of investment that are considered while making the investment. Okay, thank you. Best wishes.